Lithium Americas Corp., trading under the ticker symbol LAC on the New York Stock Exchange, is currently priced at $3.11 per share, marking an intraday gain of 4.14% as of the latest market session. To a casual observer checking quick market updates on a phone, a 4% upward daily move might feel like the beginning of a true recovery for a stock that has suffered a grueling drop of more than 34% since the start of the year. However, beneath that single green trading session lies a deep, unresolved tension between what retail market participants expect and what the balance sheet actually demonstrates. The widespread narrative across online trading communities, whether people are discussing trades on Robinhood stock trading forums or monitoring their positions through a SoFi Invest account, is that securing North American lithium supply is an automatic long-term winner as electric vehicle adoption expands. The market expectation assumes that owning the premier domestic deposit in the United States makes the company an effortless strategic hold, but the hard reality is far more complex. Lithium Americas is a pre-revenue mining enterprise carrying a capital build-out requirement that drastically exceeds its total equity market capitalization. When a company needs billions to construct its core project while holding a market valuation under $1.1 billion, every daily price swing becomes a battle between long-term strategic potential and immediate financial survival. A closer inspection of recent stock movement reveals how intensely sentiment has shifted over recent trading quarters. Daily price fluctuations for LAC have been characterized by elevated volatility and sudden volume surges, particularly on down days where broader commodity weakness drags mining equities lower. Investors utilizing Interactive Brokers trading tools or analyzing real-time technical indicators on the Fidelity mobile app have watched the stock repeatedly test multi-year support zones around the $3 level. Retail volume across platforms like SoFi Active Investing, Robinhood Stock Trading, Robinhood Fractional Shares, and self-directed individual brokerage setups at Fidelity Investments has shown attempts to accumulate shares on dips drawn in by attractive traditional valuation metrics. For instance, the stock currently trades at a price-to-book ratio of approximately 0.8 times. In plain terms, that means the stock is selling for less than the net accounting value of its assets, standing at a massive discount compared to the broader metals and mining industry average of roughly 2.5 times book value. On paper, that metric looks like an obvious value play for anyone engaging in online investing, learning how to invest online, or searching for investment help through self-managed accounts. Yet institutional portfolio managers have been far more cautious. Capital flows originating from major institutional funds, whether managed inside Fidelity mutual funds, holding Fidelity ETFs, structured within Schwab Intelligent Portfolios, or directed through institutional Fidelity wealth management accounts, have largely stayed on the sidelines. Professional managers recognize that a low price-to-book ratio in an active development project is often a reflection of capital risk rather than an immediate buying signal. The fundamental driver behind this institutional hesitation becomes clear when examining recent financial reports and macroeconomic headwinds. In its recent quarterly filings, Lithium Americas continues to show net losses, reporting a first-quarter loss of 4 cents per share alongside recurring operating expenses tied to engineering, legal, and site preparation work. Because the business has zero commercial production at this stage, cash outflow is continuous, placing immense weight on capital preservation. This internal balance sheet pressure is compounded by external macroeconomic forces impacting the entire clean energy sector. Global spot prices for battery-grade lithium carbonate have experienced a severe downturn from their historic highs, driven by increased international supply and a temporary deceleration in the growth rate of electric vehicle sales. This macro softening affects sentiment across high-profile EV market leaders like Tesla stock, which in turn ripples downstream into upstream material suppliers. When end-market manufacturers adjust production targets or reevaluate battery chemistry mixes, raw material developers feel the squeeze immediately. Investors monitoring portfolio performance on popular investing sites or using automated rebalancing through an intelligent portfolio service must realize that Lithium Americas cannot escape the overarching commodity cycle. Market participants are no longer willing to assign speculative future valuation multiples to development stage miners. Instead, they demand clear execution pathways, firm project completion dates, and protected balance sheets. This divide between market narrative and financial execution is exactly why keeping a close eye on sentiment is critical for any long-term investor. Before we walk through the specific asset details, project economics, and corporate partnerships driving Thacker Pass forward, I want to get your thoughts directly. Comment below how many shares of Lithium Americas Corp you currently hold in your portfolio, or tell us what target price you are waiting for before taking a position. Whether you manage your holdings through the Robinhood app, explore Robinhood crypto assets, run an active trading strategy via Interactive Brokers platform, or maintain long-term holdings inside Fidelity IRAs, sharing real insights helps the entire community evaluate how individual expectations stack up against market reality. To accurately evaluate where the stock goes from here, we need to analyze the underlying asset that forms the foundation of the entire company. Headquartered in Vancouver, British Columbia, Lithium Americas Corp was created as a standalone entity to focus specifically on developing the Thacker Pass lithium project in Humboldt County, Nevada. Thacker Pass represents the largest known sedimentary lithium deposit in the United States and one of the largest globally. To transform this massive natural resource into an active commercial asset, the company secured major strategic backing that initially set high expectations across Wall Street. General Motors committed a total investment package reaching $945 million, establishing a joint venture structure that provides GM with exclusive offtake rights to Phase 1 production for battery cell manufacturing. Furthermore, the U.S. Department of Energy finalized a major restructuring of a $2.26 billion direct loan agreement, even acquiring equity stakes in the company and the project to ensure domestic battery material supply chains remain secure. On the surface, having nearly $900 million in strategic backing from an automotive giant like GM, alongside billions in federal loan guarantees, creates the impression of an impregnable moat. This expectation led many investors executing trades on SoFi stocks, SoFi ETFs, using Robinhood stock trading, or operating through an individual brokerage at Fidelity Investments to view the stock as a low-risk way to capitalize on North American battery independence. But the deeper reality centers on the absolute scale of the remaining capital expenditure requirement. Building out Phase 1 of Thacker Pass requires an estimated capital expenditure of up to $1.6 billion in upcoming construction cycles alone, against a current corporate market cap hovering around $1 billion. Managing a multi-billion-dollar construction effort in a remote location introduces significant execution risks, ranging from equipment supply chain delays and labor availability to inflation in specialized chemical processing components. Furthermore, drawing down on federal loan facilities requires meeting strict compliance conditions, equity matching ratios, and operational benchmarks. For self-directed investors engaged in self-investing across platforms like Interactive Brokers Account Options, SoFi Trading Platform, or SoFi Active Investing, the central risk factor is share dilution. If capital overruns occur or a full commercial production shifts past the targeted 2027 window, management may be forced to issue additional equity at depressed market prices, diluting existing shareholders before meaningful cash flows begin. Looking forward, the long-term trajectory of Lithium Americas will depend on a clear interplay of catalysts, risks, and market timing. On the bullish side of the equation, the core catalyst is project completion and commodity price stabilization. If global demand for battery materials accelerates, driven by expanded production lines for market giants like Apple stock entering automated systems, NVIDIA stock powering AI-driven industrial robotics, and Tesla stock scaling mass-market energy storage, lithium spot prices could experience a sustained rebound. Under that favorable macro environment, Thacker Pass would transition from a cash-draining capital project into an essential cash-generating asset producing 40,000 tons of battery-grade lithium carbonate annually. Wall Street analysts currently hold an average 12-month price target near $6 per share on the stock, representing significant upside potential from current $3 levels if key construction milestones are hit on schedule. On the bearish side of the equation, prolonged weakness in global lithium prices or unexpected construction delays could force further financial restructuring, keeping the share price range-bound or pushing it lower. Investors weighing an online investment through Robinhood Cash Management, SoFi Robo-Advisor, Interactive Brokers Fees Evaluations, or specialized accounts on Interactive Brokers stock trading must carefully weigh these two distinct paths. In conclusion, Lithium Americas Corp provides a clear example of the contrast between market expectations and financial reality. The popular expectation views the company as a government-backed, automotive-funded powerhouse poised to dominate domestic lithium production. The reality, as reflected in daily trading feeds on the Fidelity trading platform, Robinhood Investments, and major brokerages, is that capital-intensive mining development is filled with execution risks, balance sheet pressures, and commodity price vulnerability. For investors seeking investment help or navigating the market through an intelligent portfolio, success requires looking past optimistic headlines and paying strict attention to project timelines, capital preservation,